Welcome back to another edition of Special Situations Investing with Greg. This week I'll be answering the second half of Ben's question. Check it out. Hey everyone, welcome back to another edition of my YouTube channel on Special Situations Investing and my personal investing practice. As a quick disclaimer, this video is for educational purposes only. Any companies that I mention in this presentation are discussed solely for illustrative purposes. Discussing such companies and the specifics about them is to help educate me and educate you about certain special situations. It is not a solicitation to purchase them. I recommend that you conduct your own research and identify why you might want to own the company yourself prior to your committing of any funds. I also recommend that you seek the services of a financial advisor that has considered your personal situation as your fiduciary. And then finally, may your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks a bunch for watching. Now on to the video. Last week I spent my time answering the question for Ben about where do you find the documents for spinoffs, and we went into the Aaron's Progressive spinoff that occurred in 2021. And but then Ben also wanted me to kind of walk him through, like, how do I get to a number and how do I identify if a company is worth what they are, and if it's a good deal post spinoff. And this line of questioning actually reminds me a lot of some of the initial forays that I had into the investing practice. And I always, when I first got in, the thing that I thought was, hey, I got to have that number. Once I figure out that number and if I get it just right, I'm going to be successful. I found, however, over time that in reality the thing that you really need to understand is you need to understand the business, especially when we're talking about spinoffs. You need to understand how the business will perform over time. If you do understand who the business's customers are, how they make or generate their cash flow, you're going to understand how to approach the business when it comes to the valuation process. And you will also have a better understanding of what to expect sometimes when the share prices will fluctuate. When I do my research on a company, one of the biggest things that I'm trying to find out is, will it be a going concern in 5 to 10 years? Because usually my holding period is between that time frame, because I want to make sure that if the company is going to be around in 5 to 10 years, the likelihood that it disappears as a going concern is minimal, and that will mean that I've got my money invested in something that should be a pretty good opportunity. In my opinion, understanding that the business is going to be a going concern is the most important thing that you're going to determine. Calculating what price you're paying for the company or anything like that afterwards is secondary or even tertiary to all the other stuff that you have to do for an investment. So our focus, or my focus, is I want to protect my assets. And if I can protect my assets, then the next thing, eventually I'm just going to have upside that will go well. The second thing that this question prompted me to think back on is that often when we are doing calculations of how much a company is worth, this is an approximation of value. We don't know the exact amount because we don't know what the exact numbers will be over the next 5 to 10 years. Or next year, for that matter. We just don't have an idea of that. And so you have to realize that the thing that you're doing is you're trying to look into the future and identify what it is. Unfortunately, you can't do that because you don't know what the markets will do in the next 6 to 12 months. You don't know what the individual businesses will do in the next 6 to 12 months. This changed my focus to, I have to have a good number, to I'm okay with a good enough number or an approximation of value. And if I can have a decent approximation of value for the company, then that helps me identify that, it's either obvious or it's not obvious. And if it's an obvious position to take, then I'm just going to go ahead and take it. And I get this idea from Warren Buffett where he says, it's better to be approximately right than precisely wrong. And when I was researching this video, I think it's really interesting because I'm pretty sure he got that from as his own reading of John Maynard Keynes. And so if one of the things to think about when you're investing, and this is just my sidebar on this, but one of the things that you need to think about when you're investing is you probably will spend a lot of time reading, and you'll read a lot of different things. And if you have a good approximation of value, then usually you're going to be good enough to do well with what you're doing. This mindset of being roughly right helps me understand what I'm trying to do when I evaluate the company. Because I'm not valuing a known quantity, these future earnings, and I have the approximate value I expect a company to earn, in my opinion, the best way to determine this is by looking through the past operating results and then comparing that to similar companies. Now, one thing that you'll run into, and we are going to run into this with Aaron's, is that sometimes companies have like this niche. And when they have a little niche, you may think, oh, well, I can't make a comparison. Well, in reality, most of the time, if they have a niche that they have little competition in, then there's barriers to entry that make it harder for them to have that competition. And it makes it better for them over time to make money. The other thing is I want to have an accurate rough approximation. Accurate rough approximations are all over the business world. Some things that come to mind when I think about accurate approximations. Real estate, usually when investors get into that one, they have an accurate approximation that they're looking to buy or sell properties somewhere in the 5 to 9 cap rates. And so 5 cap rate or 9 cap rate, basically this is just the capitalization rate on the investment. So it's going to generate 5 to 9% return over time based on that initial investment that you go into. Another approximation that I think about is payback. So, and this also is something that I think about when I think about real estate, but another area that payback is really common in is when companies buy income producing or production assets. So you buy a computer chip making machine or a silicon wafer making machine, and you determine how many units you have to sell and at what price in order to pay back the cost of that machine over time. Usually your payback should be somewhere less than about 3 years for most income producing assets. And this brings me how I approximate if a company is generating wealth. I calculate the value of the company by taking the enterprise value of the company, and then I divide it by the owner earnings, or earnings before interest and taxes. I compare the resulting number to the best comparables that I can find in the industry, and then I use that to get approximations of what I think the company's value is. And if I can't find approximations, then I will come up with my own idea of what I think it should be, and I just accept the fact if I don't have a good comparable, then I will go ahead and I may never invest in it because I don't have enough information in order to make a decision. So let's go on back to that SEC filing, and if you don't know where to find the SEC filing, go back to my video from last week. You can take a look at it and you can identify what you can read through the filing and you can kind of walk through this with me. Okay, so I come to the schedule 10-12B, and I go down here and I go to here, unaudited pro forma condensed but combined balance sheets. And so you can read through all this if you want to. It's probably good if you've never done it to read through it and just kind of understand what they're talking about. But then you go here to the pro forma balance sheet and you have the assets. And what we're calculating is, the first thing that we want to calculate is we want to calculate the value of the enterprise. So we take first the cash and cash equivalents. You notice that a bunch of this cash got put away and given to Prague Holdings when they had this happen. And so the Aaron's company has 45 million on their balance sheet after the spinoff was to occur. The second thing that we look for is the liabilities. And so I take here the total liabilities. So we have 45 million, and you can round to like 3 decimal places or 4 decimal places. And that's what I do here. So I'm just going to take 660 as my liabilities in equity. And I take everything. It's a little bit of a conservative view on this, but I take all of that. I take the cash, and then I go down here and I identify how many shares are outstanding. So after the tender or after the spinoff occurs, there's going to be approximately 34 million shares outstanding. And so Aaron's company should have 34 times something plus the total amount of the liabilities, which would be that 660. So 660 minus your cash and cash equivalents. That number is your enterprise value. Now, the enterprise value can get a little bit more convoluted if you have like preferred shares and stuff like that, but we'll just focus on what we have here. And the things that we're looking at are the debt, and then the common equity, and in this case, cash. And so we take that away. It's basically 615 million minus something multiplied by 34. And if I look at Aaron's company about that time, it was trading around $24 a share. Okay. And so we'll take that $24 and we times that by 34, and that gives us a total. And I'll just do this on the calculator right here. So you make it easy on yourself. You just take your 34 and you times that by, in this case, it was approximately $24 a share. So 816 million in equity. We add to that equity our 660, and then we subtract 45 million for cash. And so basically the enterprise as a going concern is approximately $1.4 billion. And with that, that is our enterprise value. And that's our first portion of the valuation process. Now, the next thing that we want to do is we want to get this as a ratio. And the ratio that I'm looking for is basically operating earnings per the enterprise value. And so I've got here my enterprise value. I'm going to write it down, 14 or 1.4 million or billion. And then on page 53, I see here, this is 9 months. So be careful with this. Make sure that you're paying attention to these dates. But 9 months, there's some pro forma data here. We have gross profit. We take this. We're going to take away the operating expenses that are going to be recurring. And so recurring operating expenses that I'm looking at this, I definitely am going to have personnel costs going forward. There's other operating expenses. It looks like they have these other operating expenses every single time. It's pretty general. This is something where you have to understand the business well enough to be able to make that call. In my case, I did some digging on this one. I'm like, yeah, they're going to continue to have other operating expenses on this. And then the next thing, this provision for lease merchandise write-offs. Because they are a rent-to-own place, Aaron's Rentals will always have some sort of provision for their lease merchandise write-offs. And so I'm looking at those 3 items. Those are definitely things that are going to happen. And then we have this other one, restructuring expenses. Well, restructuring doesn't always occur. And in my case, I'm going to go ahead and get rid of the restructuring. And then the next one is an impairment to goodwill. And that's also something that is not there. Now, goodwill can be an issue sometimes, because realize that goodwill, that means that a company went out and they bought something. They bought the sky basically on a company, and then they lost all the money that came out of that premium valuation. So just be aware, if a management team keeps doing that, you may not want to be around with the management team. It doesn't necessarily mean that the business is bad, but when we're thinking about accounting, we may not always include that. And so if I take out these last 2, the restructuring expenses and the impairment for goodwill, the actual operating profit, because it doesn't turn into a loss anymore, it turns out to be about 88 million. And this is 88 million over a 9-month period. And so I'm looking at that, okay, 88 million. If I do an annualized version of that, it'd be about 117 million. And that just kind of gives me an idea. And then I would take that enterprise value and I would divide it by that annualized amount. And so in this case, I'm doing 117. And this gives me 12.2, or basically 12 times the annualized earnings for 2020 is what it was trading at, with $24 a share. Okay, so let's get back to 117. We'll get back to that enterprise value, but we can also go back a year earlier, and we can do the exact same thing, kind of get ourselves, make sure that we're doing some sanity checks. And so we'll go here. We got the gross profit. Personnel costs a little bit higher this last year. Well, obvious, because this is during the COVID period. And then you have your operating expenses and all that other stuff. Provision for lease write-offs. Notice it's also pretty high, or it also is a consistent line item. And then these restructuring. And so sometimes restructuring happens a lot. In this case, I think for me, I was looking at the restructuring. I was like, they're going to have these restructuring expenses over a 2 to 3 year period. I'll take out the 40 million, or I'll put the 40 million back in, just to kind of get a feel for what the business is actually creating. And in this case, you come up with 87 million, basically this 47 plus the 39 right there. And so 47 here under the operating profit plus that. And that gives you kind of an idea of what the operating earnings will be. And so 87 million, okay, that's a good gut check. So 87 million to 117 million. Yeah, sometimes things are going to go up and down, but that kind of gets us in a ballpark, and we have an idea of how much money the company should be earning over time. Now, if I took that 87 and I divided it into that 1.4 billion, that gives me about 16 times. And so we're looking at somewhere between 12 and 16 times your owner earnings. And for a retailer that is on the public markets, I think that's actually a pretty reasonable price. I tried to find decent comparables when I was looking at Aaron's, and it's part of the reason why I didn't get into it. Aaron's is a specialty retail, and they do a rent-to-own business. I mean, we could get into something like pawn shops. That might be another similar type business, but it is not like something that I can compare with other specialty retailers. I'm not going to go out there and compare it to like O'Reilly's or one of those types of companies, because they have a totally different business model. Because this business model is dependent on customers coming in and purchasing shares or purchasing business, their things on credit. To me, that is their business model. And so I made an estimation, and Ben, you may not like this, but the answer for me was, if I can get this for 10x that number, then I'm probably going to do all right over time. And so I take that operating expense. Hey, it's 100 million. It's probably a good estimate. If I can get the company for less than 10 billion, then that's pretty good. And then I take 10 billion, or excuse me, not 10 billion, 1 billion. So if I take 1 billion and I take away all the debt and the cash, that gives me 385. So 385 million. And then I divide it by the shares that I know are going to be there. So if I could buy the company for, $11 a share, then it's probably going to be, I'm probably going to do just fine over time. And with a spinoff, if I can hold it for 10 years, I'm pretty sure that it's going to do just fine over that time, especially if it's a company like Aaron's that's pretty well established. They're probably going to be around for the next several years. And I don't see any reason why they wouldn't be doing better. In fact, if you dig into their stuff a little bit more, is you look at their market opportunity, they understand that if they have, there's all these people that have no credit score or have a credit score below 650. So 100 million people in the United States. And then they basically identify that they are within 43% of all households. Now I recognize, again, last week we talked about how sometimes, your CEOs, they're salespeople at heart, and they're going to try to sell you on what they're doing. But you have to understand the business well enough to make the decision of whether or not this is the right price or not. And this is part of the reason how you make that right price. Anyway, going back to this, I basically calculated that if I was going to get into Aaron's, I would want it somewhere around in that $11 to $12 per share range, and that is no changes to the business. And so at $11 to $12 a share, I feel pretty confident that it's going to be just fine over time, and that would be kind of my entry price for it. So Ben, hopefully that helps you understand how I come up with a calculation on this. I would recommend that if you're going to do this, you need to spend some time just understanding the business, and then don't try to overthink it. The more you overthink it and you feel, I got to get everything perfect, the more you're going to be pulling away from people that are really good. And I'm not talking about myself, I'm talking about people like Warren Buffett, that they say, if we can make this as easy as possible, I will go ahead and do it. Joel Greenblatt, he also is one that, he says, don't make things harder on yourself. Just do the quick calculations. If it makes sense, go ahead and jump. If it's not, then don't. Just move on. You don't want to spend your time so concerned about everything that you do that you make the mistake on things that are, you're looking at that tiny little speck, and in reality the big picture is you just have to spend some time digging into this, and you'll understand it over time. With that in mind, thanks a bunch for watching this video, and if you are around here, you're somebody new, and you kind of like how I responded to Ben's question, you have your own question, please set them in the subscribers or in the comment section below. I have a question from last week talking about how I evaluate how a management team gets their information, and I'll be talking about that one next week. So please go ahead and ask your questions. I am more than happy to answer on this video or on this YouTube channel, and I appreciate all of you for watching. If you like this video, please hit the subscribe button or the thumbs up button and tell me that you like it, because it helps me identify that what I'm creating is content worth value. And appreciate you for your time. We will catch you next week.